Welcome, ladies and gentlemen. My name is Peter Youssef. I'm the Senior Analyst with IronFX. Together, we'll be going through a webinar about the week ahead, namely June 21st to 25th. That's Monday to Friday. Before we start, though, I will allow you for a couple of seconds to go through our risk warning and the disclaimer. Now, as you are reading the risk warning and the disclaimer, let me make a small intro. Now, with the Fed interest rate decision reviving the USD and the market still digesting the US central bank's new guidance, we open a window into the coming week. It's characteristic that the Fed's interest rate decision is actually still creating waves of volatility in the FX market. Now, on the monetary front, we highlight BOE's interest rate decision, while we also note the release of CMB's interest rate decision from the Czech Republic. As for financial releases, we note on Monday, the 21st of June, Australia's preliminary retail sales growth rate for May. On Tuesday's UK CBI industrial trends regarding orders for June. On Wednesday, the preliminary PMI readings for June from a wide number of countries. On Thursday, we focus on the US releases and highlight the final GDP rate for Q1. And on Friday, we get the US consumption rate for May among a number of releases. Please note that you can always download the handout, which is uploaded the dashboard next to you. Let's start. Now, this would be the USD index for our chart. Note how practically the index has gained an upswing since the Fed's interest rate decision, practically breaking every resistance line in its path, turning them now into support. We tend to maintain a bullish outlook for the index, as practically the USD strengthening has been evident across every major pair. Specific support lines to take a note should the index reverse direction start dropping would be first the S1 91.75. Even lower than that would be the 91.30, and the lowest level we have mentioned would be the 90.75 S3. To the upside, we would start with the R1 92.30. Even higher than that would be the 92.75, and even higher than these fundamentals. Practically, the Fed's interest rate decision revived the buying interest for the USD, albeit it should be noted that last week the USD ended in the greens as well. Maybe the element which stood out the most was that the Fed projected earlier rate hikes, the first of its post-pandemic monetary policy, which are expected now to take place in 2023. The bank's chairman, Jerome Powell, also noted that there had also been discussions about tapering the bank's QE program. It's characteristic that the bank, in its accompanying statement, stated that amid the progress made with vaccinations and strong policy, indicators of economic activity and employment have strengthened, while in his press conference, the Fed's chairman, Jerome Powell, stated that it's clear we are on a path to a very strong labor market. We expect the Fed's monetary policy to remain one of the main issues directing the USD in the coming week. Hence, we would highlight any planned speeches by Fed policymakers. On a more fundamental level, we would note the US foreign relationships, as the Biden administration is attempting a turn from the Trump era. Especially a deterioration in the US-Sino relationships is possible and could provide some safe haven inflows for the USD. As for financial releases, the calendar is rather light on Monday and Tuesday for the USD, and we note on Wednesday the preliminary market PMI figures for June. On Thursday, we get the US durable goods orders for May and the weekly initial jobless claims figure, but the star is expected to be the final GDP rate for Q1. On Friday, we note the US consumption rate for May and the final University of Michigan consumer sentiment for June. Moving now to the pound, and this would be cable, GBP USD for our chart. Now, cable, vice versa, has been dropping due to the US dollar strengthening. and has now be aimed. We tend to maintain a bearish outlook for the pair, especially given that the RSI indicator is below the reading of 30. However, the fact that the RSI is below 30 could also imply that the pair is rather oversold. Nevertheless, to the downside, we highlight the 1.3845 support line, which tended also to provide some support early May. That should be around the 5th and 6th of the month. Even lower than that, we would highlight the 1.3670, and higher than that, the 1.3525. To the upside, we would note the 1.3990, which practically reversed any slight bullish tendencies the pair may have had yesterday, practically pushing it lower once again. Higher than that, we would highlight the 1.4145, and even higher than that, the highest level noted would be the 1.4275. Once again, we highlight that the direction for the time being is downwards. Moving to the pound's fundamentals, the pound seems to be losing ground this week against the USD and JPY, yet seems to hold its ground against the euro. Fundamentally, we tend to maintain our worries, as it seems that the number of new daily cases of COVID is rising in the UK, reaching yesterday a new record high at 11K since the last wave that struck the UK and ended back in February. It should be noted that the cases are on the rise despite a wide part of the UK population having received at least one vaccination shot, as the UK government has stated that 8 in 10 adults have now had the first vaccine shot. On the monetary front, we highlight BOE Haldane's comments that the UK economy may be near pre-pandemic output levels, which sounds quite optimistic, and may reflect the confidence of England's central bank. BOE is expected to draw considerable attention next week, as it will be releasing its interest rate decision on Thursday. The bank is widely expected to remain on hold at 0.10%, and currently GBP/OIS imply that the market has almost fully priced in such a scenario materializing. Also, we may not see the bank start tapering its QE program just yet, but it will be interesting to see whether the bank will intensify its inclination towards that end. Overall, we expect the bank to sound confident, albeit may at some time warn about the risks posed by the rising financial releases. We note the release of the CBI industrial trends regarding orders for June on Tuesday. On Wednesday, we highlight the release of June's preliminary market PMI figures for the services and manufacturing sectors, and on Friday, June's CPI indicator regarding retail trade. Moving now to the Japanese yen, and this would be USD JPYs for our chart. Note the clear upward trend line despite the drop of the pair over the past 1.5 days. Now, specific support and resistances levels noted would be the 109.95 to the downside at first, which used to be a resistance line, now it's turned into support. Lower than that would be the 109.25, which provided support for the pair on the 5th and 6th and 10th of June. And even lower than that would be the 108.35, which practically reversed any bearish tensions of the pair during the 7th till the 10th of May. To the upside, we highlight the 110.90 resistance line, and even higher than that, the 111.70, while the highest level noted would be the 112.25. Now, moving to JPY's fundamentals, JPY seems to be losing ground against the USD for a second consecutive week. Nevertheless, JPY seemed to move the least among major currencies against the USD during the release of the Fed's interest rate decision, possibly indicating that traders were not so willing to abandon the yen at this stage. Now, BOJ's interest rate decision early this morning didn't help much, leaving traders rather unimpressed, despite the bank remaining on hold, as was widely expected. It should be noted that it also extended its pandemic relief program in another sign of the bank's dovishness, while in another move, it announced its first green investment fund. In his press conference later, BOJ Governor Kuroda is reported to have said that the pandemic has still a big negative impact on the economy, as well as that the bank will not hesitate to ease monetary policy further if needed. On JPY's fundamentals, we highlight the easing of the state of emergency and special for Tokyo, while the path of holding the pandemics in 1.5 months' time seems to be clearing. It's characteristic that the increase of COVID vaccinations has improved confidence, and Japan aims to issue vaccination passports by the end of July. Given that BOJ's interest rate decision is already out, and there is a low number of high-impact financial releases scheduled for next week, we tend to expect safe haven flows to move the Japanese currency along with fundamentals. Nevertheless, we would note the release of Japan's preliminary Jibun Bank Manufacturing PMI for June, due out on Wednesday, and on Friday, the release of Tokyo's CPI rates for June. Moving now to the common currency, and this would be Euro-USDs for our chart. Now, Euro-USD had a downward slope, which intensified heavily after the Fed's interest rate decision. You can see the reaction, how it dropped, breaking practically the 1.2090 and the 1.1990, and it's now testing the 1.1885. Specific levels to keep an eye out would be to the downside, the S1, 1.1885, which tended to provide some support a day before. Even lower than that would be the 1.1785, and the lowest level noted would be the 1.1695. To the upside, we start with the 1.1990, which supported the pair's prices after the initial reaction of the market to the Fed's interest rate decision, yet it was broken later on, hence turned to resistance. Higher than that would be the 1.2090, and even higher than that, the 1.2175. Once again, we remind our listeners that the direction is clearly to the downside for the time being. However, the RSI indicator remains below the reading of 30, confirming the dominance of the bears, yet at the same time may be implying that practically the pair may be oversold and the correction higher could be in the cards. Moving to the common currencies fundamentals. Now, the currency seems about to end one of its worst weeks against the US dollar since August past year, yet seems to remain rather stable against the pound. On the fundamental side, the progress made with vaccination in the EU seems to be ongoing, and characteristically, the number of new daily cases seems to remain rather low in France and Germany. It's characteristic that the EU has lifted travel restrictions for US citizens in the most recent move towards normality. On the monetary front, ECB's loose policy seems to continue, thus contributing to the devaluation of the single currency. It's characteristic that ECB's chief strategist, Philip Lane, stated that it is premature to talk about end of PEP, while highlighted the importance of the September meeting, and also stated that it will take a long time for the labor market to recover. As for financial releases, Euro traders are to have a start on Tuesday with the release of the zone's preliminary consumer confidence indicator for June. On Wednesday, we highlight June's preliminary PMI readings for France, Germany, and the Eurozone. We tend to focus on France's services sector, which is among the earlier releases, yet the heavy point is expected to be Germany's manufacturing sector indicator. And for a more complete picture, we note Eurozone's composite PMI reading. On Thursday, we get Germany's IFO indicators for June. And on Friday, Germany's GfK consumer confidence, which along with Thursday's releases provides a more complete picture of business and consumer expectations for the largest economy of the area. Moving now to the Aussie, and this would be AUD-USDs for our chart. Important levels to keep in mind as the pair proceeds with a clear downward motion due to the USD strengthening would be the S1 0.7465, the S2 0.74, and even lower than that would be the S3 0.7335. To the upside, we would note the 0.7530, higher than that would be the 0.7595, and the highest level noted would be the 0.7665. Moving now to the Aussie's fundamentals. Now, like every other currency, the Aussie was also not able to resist the strengthening of the USD, yet against its eastern neighbor, the NZD, it held its ground. On a fundamental level, we note the ceiling of the UK-Australian trade deal, yet we maintain our worries for the adverse effect of a possible escalation in the tensions of the US-China relationships. On the monetary front, we note RBA Governor Lowe's comments, who highlighted that it may be premature for the bank to end its bond buying program. Once again, the governor underscored that inflation pressures remain subdued and are likely to remain so, while wages growth also subdued as firms focus on curbing costs. It should be noted, though, that the Australian employment market seems to be tightening, at least given the data for May released on Thursday's Asian session. The employment change figure skyrocketed, reaching 115.2K, while the unemployment rate dropped as low as 5.1%. Also, we would note that iron ore prices have started to rise once again, and it's characteristic that yesterday they reached a new one-month high, which may also provide some support for the Aussie, given that iron ore is one of the main export products of Australia. As for financial releases, Aussie traders are to have an early start next week, as the preliminary retail sales growth rate for May is due out on Monday's Asian session, while on Wednesday we get the preliminary PMI readings for June. Moving now to the Canadian dollar, and this would be USD CADs for our chart. Definitely the pair had escaped its sideways movement since last week. However, with the Fed's interest rate decision on Wednesday, it hit through the roof. It cut through resistance lines like a hot knife through butter, breaking the 1.2230 as well as the 1.2320 resistance line, both now turned to support, and continued higher today to test the 1.24 resistance line. Now, specific levels to keep an eye out would be to the downside. We have mentioned the 1.2320 and the 1.2230. Even lower than that would be the 1.2140, which was tested also as a support line, but as a resistance line as well. So practically, it has proven its worth. To the upside, we highlight the 1.24, which is currently being tested. Higher than that would be the 1.2470, and even higher, the 1.2560. May I remind our listeners that practically the pair's direction is intense to the upwards, and we highlight the fact that the RSI indicator below the 4-hour chart is above the reading of 70 with an upward slope, confirming the dominance of the bulls, yet may at the same time provoke a correction lower, as the pair may be considered to be overbought. Now, moving to the fundamentals of the Canadian dollar, the Canadian dollar retreated against the USD, reaching levels not seen since the last days of April. Fundamentally, the risk sentiment of the market seems to adversely affect the loonie, given also that the monetary outlook differentials of the BOC with its southern neighbor, the Fed, have started to rebalance somewhat. It should be noted that BOC Governor Tiff Macklem stated 2 days ago that the bank is seeing signs that the housing market is cooling down, while before the Canadian Senate, he also stated that further adjustments to the bank's QE program are to be gradual. On the other hand, it should be noted that oil prices seem to be on the retreat for the past 2 days, pressured by the strengthening USD. Yet at the same time, the demand outlook for black gold may not be as strong as originally considered. Nevertheless, WTI prices seem to continue to be close but above the $70 threshold, which may be among the positives for CAD, albeit the drop of oil prices as such could be weighing on the loonie, given that oil is among the main export products of Canada. As for financial releases next week, we note the release of Canada's retail sales growth rate for April on Wednesday. Now, that should sum it up, but before we leave you, as a final note, we expect the greenback to maintain the initiative over its counterparts in the coming week, albeit in the first days we may see financial releases providing more attention for other currencies. Now, also given the timing of high-impact financial data, we may see the balance of fundamentals and financial releases being tilted towards the latter, towards financial releases on Wednesday and Thursday. Now, beyond the Forex market, we may see US stock markets digesting the confusion created by the Fed's interest rate decision, albeit it should be noted that Nasdaq yesterday reached a new record high, given also that US yields edged lower. Should US yields continue to drop or remain As for precious metals, we tend to highlight the losses of gold, which retreated below the psychological threshold of $1,800, breaking the upward trend line guiding it. Gold has started to recover some of the lost ground today, yet whether that tendency is to continue in the coming week remains to be seen. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.